There, but now
Are we ready?
we just verifying that we are live. Yep, we are live and we have 5.
All righty. Good afternoon, everyone.
Good afternoon.
Good afternoon.
I'd like to open up today's investment meeting for September 19th for our fund, and I'd like to have Sue do a roll call vote, please.
Angela Banks. Christina Bennett.
Present.
Lois Cross.
Present.
Sheila Goodwin. Emily Hubbard. Shanice Johnson.
Present.
Yvette Levy. Bobby Richardson.
Present.
Albert Sanders. Doris Walker.
Present.
Martell Mann.
Present.
All right, so we have 6 and we do have a quorum.
You're on mute, Christina.
With the quorum, I'd like to proceed and hand over the meeting to go through our agenda with Gwelda and Jeff from Mariner. The
Okay.
floor is yours, Gwelda. Thank you.
Okay. Yes, you have one of your opportunistic fixed income managers in the waiting room, Neuberger Berman. And we're going to have a discussion after they present after Robin Skeller and before the flash report. We'll talk about that segment. But they currently have a little bit over $28 million with you all and have been with you since 2017. So you can go ahead and bring them in from the waiting room.
Okay. There's 4 of them.
Hello there.
Hello.
Hello.
Welcome.
Hi. How is everyone?
Going
Everybody
good. So I'm Christina Bennett. I'm the investment chair for the retirement fund, and I'm going to allow just a moment to introduce our trustees and have them introduce themselves so that you can put a name with the face for those that are on camera. But Chairman Cross, can you start?
Yeah, I'm Louis Cross III. I'm chairman of the PSRS STL board.
Good evening. My name is Bobby Richardson, and I'm the vice chair of this board. Thank you and welcome.
I'm Doris Walker. I'm the legislative co-chair.
Martell, is he there?
Or Shanice?
Or Shanice?
Shanice and Martell.
Okay, I didn't want to go out of turn. Shanice Johnson. I am the co-chair of the Benefits Committee.
And my name is Martell Mann. I'm the co-chair of the Personnel and Professional Contracts Committee.
Thank you, everyone. Well, I'm going to hand it over to Gwelda and to Jeff, who are our consultants at Mariner, to go through our process and procedures and then move forward with your presentation.
Okay. You all will have 30 minutes to make your presentation to the investment committee, and the floor is yours.
And I'll
put your presentation up. I'm Sue, I'm the executive director here, so I will put your presentation up, and if you want me to move at any point in time, just let me know.
Okay, thank you, Sue. Appreciate that. Well, I'll introduce myself. I'm Cheryl Canistra. I am the head of North America Client Service and work on the public plans in the Midwest, and have the pleasure of working on this account. Joined with me is Sarah Strope, who is an analyst on the client servicing team, as well as Jan Janssen and Carol Sindera, who are the portfolio management team working on this strategy. If you advance to the next page, there is an overview of Neuberger Berman. And Neuberger Berman is a 100% employee-owned investment management firm. We have 481 billion under management. We've been around for over 80 years, and we have assets in fixed income, equities, and alternatives. We manage a couple of investments with you, and what we're going to be talking about today is a fixed income investment portfolio that we've been working on for a number of years, and we'll go through the history of that as well. One of the things that we pride ourselves on is that in addition to being 100% employee owned, we also are 100% aligned with our clients. And all we do is manage money for clients. That is 100% of what our focus is on, is clients' assets. And we're a lot, many of our portfolio, all of our portfolio managers are also invested in the strategies that they manage money for. We have a strong stability of the portfolio management team of retention rates. 96% of our managers have been have a strong retention there as well. And it's a culture where people want to stay, and we've been consistently in first and second place with best places to work with P&I. If you advance to the next slide, it'll show a little bit more in depth on the fixed income platform, which is a global platform. As you can, the two individuals that are on this call, it is not in the are not in the United States, and I think it's, if I got the time zones right, I think it's 10:30 around for both of them. So they're based in one of these regions in the middle of the page, off to the left, and the fixed income business, it was founded in 1981. It is growing business and has 217 billion under management for this particular fixed income area that we're managing here. Maybe at this point, I'll just pause and see if, Jan, if there's anything in particular that you wanted to highlight here before we talk about the philosophy, and then go into a little bit more depth about the strategy that we manage on behalf of the St. Louis Public School Pension Fund.
Yeah, absolutely. Thank you, and thanks for having us. Yeah, my name is Jan Janssen. I'm the lead portfolio manager for the global opportunistic strategies that we manage for multiple clients. Our client base tends to be pension-based, mainly pension funds, and this strategy was built for pension funds. We'll discuss the strategy more. I've been with the firm for since we launched this global opportunistic strategy for almost 12 years. I've been in this industry for almost 30 years. I had spent prior to joining Neuberger Berman, I spent over 15 years at JP Morgan Asset Management, heading the global ag team at JP Morgan. You know, what is noticeable for the fixed income business, we've certainly been expanding quite rapidly in outside of US, both by client base. When I joined the firm was more US centric in its office location, staff, and client, and AUM. You will see that we're now well diversified with half of our AUM coming from US, the other is international, and client types continues to be certainly very strongly institutional. And what we've done through this fixed income organization, it's expanded. We've had really strong growth through the years, through strong performance. Your strategy sits within the multi-sector, where we asset allocate across multiple sectors. That group has seen AUM grow very strongly through the years. And the team, very important here. The team has been consistent. The process has been consistent through time. We do have the ability. We'll go through the process. Both our clients, our teams are extremely well diversified across the globe. That is also very important for developing, global insight for a strategy that has the flexibility to invest across both US and internationally. And I would say, performance has been strong. AUM growth has been strong. Client retention, very strong. So if we go on the next slide, for the sake of time, obviously, please ask me to explain something in more detail. We're trying to get through a lot of material in 30 minutes. I know you wanted to cover the process, the portfolio, current portfolio, and the outlook. So we'll try to give you a good understanding of all of that, but please interrupt me and ask me if you want me to expand on any of those points. But for the sake of time, we'll go quite rapidly with sort of the highlights of it. But very importantly to our strategy, it's been consistent since I joined. One of the things that attracted me to this firm when I joined, 12 years ago, was the very strong process. It's process-led investing. Our process focuses on macro inputs. It's built on relative value analysis and fundamental research, with a very strong focus on downside management and tail risk management. Very strong commitment to research. We do our own bottom-up research in-house. That's where we extract a lot of value to our clients by buying into strong companies, strong countries, where we think the relative value and the tail risk favors investing for our clients. And very importantly, integrated platform, where we are developing insight across the globe with people and resources based around the US, around Europe, around Asia, and very broadly, so that we can benefit from insight. And in today's market, it's very difficult to even make an informed decision on any US company unless you understand what's going on in Europe and China, as that is all interlinked. And so having that continuous collaboration across the platform is very important. So if we move on, just to give you a high level of the strategy that you're invested in, the global opportunistic key objectives for this strategy is attractive alpha within a very flexible risk framework. We want to deliver fixed income like return volatility, so volatility in line with investment grade assets, even though we are allowed to invest in something that is below investment grade rated. We want to deliver to our clients more investment grade like return by using diversified relative value approach. And this is reinforced and backed up by a very experienced investment team. I've worked with all the team here for a long time. Very stable team. It's very important. Certainly really comes through in stress markets like COVID or any other stress periods. We have had multiple episodes of high stress over the last decade and before. Having a proven, repeatable process that helps you navigate a lot of uncertainty and volatility, and then having strong risk management process to guide you through through volatility and stress markets and opportunities. If you move on to the next slide, gives you a good, this shows you the composite. We'll discuss your performance. You're in line with the composite. So if you look at it since inception or over the last 10 years, we've delivered 100 basis points of alpha in this strategy. If you look at over the last 5 years, it's roughly 100 basis points. We have exceeded benchmark over the last 5 years. The last 3 years, we've been fairly defensive in our strategy. This is post invasion in Ukraine, the tightening cycle, inflation, and a lot of other things. So we have done quite significant changes to the portfolio that I will discuss, and been fairly defensive in our approach, and reduced risk in the portfolio to avoid a lot of uncertainty and tail risk that we thought was prudent to dial down the risk in the portfolio and move much closer to the benchmark than we had been in the past, and waiting for opportunities and risk premiums to be more attractive so that we can extend risk and add value to our clients. And I will go through the changes and shifts in the portfolio we've done to do that and benefit, and we're starting to benefit quite nicely. We've had a good run now prepping for the ultimate easing cycle. We'll discuss that. If you go to the next slide. It's a good visual representation of what we want to achieve in the strategy. This shows you the strategy that we managed for now 12 years. It was launched for a US pension fund, designed for a pension fund to take advantage of opportunities within fixed income and add value through time. So as I said, we've added around, annualized 100 basis points of alpha through time by delivering fixed income like volatility. So if you look at it top to bottom, you can see the alpha or return generated, and from left to right, you see the volatility created. So you can see the composite is showing up there, and then you have the global ag index. So we are moving up on a very strong Sharpe ratio from the portfolio or information ratio, where we have been adding return in line with the volatility we add. And if you compare it to the other investment grade asset classes, we have outperformed the index, we have outperformed the investment grade credit, and securitized and other investment grade asset classes, and including EMD, which includes sub-investment grade. We're not, competing against high yield and bank loans. We just show them as a reference of how we're doing versus the fixed income opportunity set. And on an upside, we capture a lot of the upside through our process. We can minimize the downside and capture the upside when opportunities present themselves. And our process is designed to identify valuations where we think it's prudent, where we think clients and our clients' money is compensated for taking more risk. And we felt that market was underpricing risk for some period of time, and therefore we have taken risk down. But through time, we always get opportunities, and they tend to present themselves every 3 to 5 years. There's always something that happens, risk premiums increase, and the market overreacts on the downside, and that creates opportunities. So that is important, and I'll go through the process of how we identify those opportunities and how we extract them into our portfolio. So if we move on to the next slide, just to give you, that's the team that works together on the global accounts. I lead the global opportunistic portfolios. They are managed against global ag. They have the opportunity set to invest outside of investment grade and outside of the index. I take the lead as PM on those strategies, all those strategies. I work with very experienced people that we have to manage the portfolio, where we have very structured investment meetings and team meetings. We work with all the resources within the organization. This is one of the strategies that benefits from the full breadth of the platform. I work with the credit team, investment grade. I work with high yield team. I work with the EMD team. I work with the FX team, the rates team. So you will get insights generated from across the platform, across the globe. And that is very important to this strategy. Very important to this strategy is also the collaboration I mentioned and the structure of the process to identify where the opportunities are and add them into the portfolio. But very broad setup. So me as a portfolio manager, I will go to it in more detail. I oversee the asset allocation and where we allocate the money. There are specific teams tasked with doing security selection. So if I am invested in investment grade, there's a specific team that is tasked with selecting the names we invest in. So if I'm adding to financials, there will be a team, a bank analyst that selects the name. So I will not be picking whether we invest in JP Morgan or Morgan Stanley. There's a bank analyst that makes those recommendations and do the issue selection. I own the overall allocation of the portfolio and setting the risk level of the portfolio that we manage for you. So if we go on to the next slide. So our process is really two building blocks. It's the sector allocation using best-in-class sector building blocks. It's the security selection that is performed by specialists within their sector. So whether it's investment grade, high yield, emerging markets, developed markets, FX, and then the asset allocation framework where we have built a tool that we've used since the inception of this strategy and your mandate, where we have built our own tool that helps us with asset allocation. And it's all built around relative value, identifying relative value. Where are the most attractive risk premiums to invest across fixed income, and help us identify and avoid tail risk and downside risk in the portfolio. And those are the key aspects. I'm going to spend a little bit more time on the asset allocation framework. So if we go on the next slide. This just gives you, breaks the process into 4 steps. It's the proprietary tool that I mentioned, where we built a specific view across all sectors. It will be investment grade credit and even subsectors within investment grade credit, high yield, the emerging markets, all the different rates markets, EM, securitized. We use both historical data and then forward-looking views that we built ourselves, and we use that, feed that into a model that helps and suggests asset allocation. It's not a black box. Ultimately, we as PMs own the asset allocation decision. It's a tool that helps us and challenges us and helps us identify how we should be allocated, how we can better diversify and take advantage of the valuation opportunities. And I will show you a slide a little bit later on that shows you how we line up those sector views across fixed income, how we rank them by return expectation, and also our confidence in those views. And this tool is based on modified Black-Litterman approach, and it's good to help us to say, what we want to remove from the process is bias. Every person, me or a high yield person, everyone will have a bias, and those tools help us take the raw information that we have built and give us a suggested asset allocation and keeps us honest. When we have built the asset allocation, we make the asset allocation how we want to be allocated, how much risk we want to allocate to different, and then we've done those sector views, then it's making that asset allocation decision. That is my role as a PM, to do the sector allocation, how we want to be positioned on duration and curve, and then how much risk we want to take, and the ongoing risk management. When we've done that, we then work with our sector teams. If we want to increase allocation to IG credit or high yield, we work with them on identifying names that we want to buy to populate that allocation. And ultimately within that investment team, we are certainly continuous. If we maintain an allocation with any of the sectors, there's ongoing issue selection, selling out of name if it becomes too expensive, and buying into other names, or if there's any fundamental change. So that ongoing management of the actual names we hold. And then throughout the process, we have an independent team that oversees risk management. I will do my own risk management, but there is an independent team that has an oversight on how much risk we're running. There is the guideline control in terms of pre-trade and post-trade guideline control, and so all the levels of risk management that you would expect. So if you go to the next, and sorry, I'm trying to get a lot of information across in a short period of time, and please ask questions if there are steps. But ultimately, when we're building this, it's very important to our process is this relative value kind of thing, approach that I have mentioned. What we want for every sector, we want to identify, instead of just focusing on a base case view for any sector, we want to understand the potential distribution of returns. So for every sector, there is we will identify different views. So we could, for example, in a simplistic form, say for investment grade credit or high yield, very sensitive to economic performance. We will look at what happens if the economy grows below trend or we go into recession. How are corporate fundamentals? What would we expect for downgrades, default rates? And how would the sector perform given current valuations and corporate fundamentals? We could grow trend like or below trend, but or trend like above trend. All those would create different behaviors for the sector, given fundamentals and everything I mentioned. And we assign probabilities, and that gives us an expectation of how the sector could perform, and gives us an understanding of how well are we compensated for investing in credit or emerging markets or any rates market. And we want to identify sectors where we have a tight distribution, what we call high confidence. We are confident that we are going to get returns in line with that sort of, and you can see those two curves. We want to, like the blue one, it's narrow. We think there's less uncertainty in that sector, or we're well compensated, overly compensated relative to the risk that we see out there. And that is key to our process, both to identify strong relative value, where valuations are strong. We also want to understand the tail risk of investing in that sector, and that is, are risk premiums enough to compensate us? So, for example, in 2016, we had a slowdown. We looked at risk premiums. We did all those scenarios. We came to the conclusion in February 2016 that the market was oversold. We liked high yield. We invested in it. We strongly performed from that. COVID was another period where there was significant dislocation, having process, identifying the best sectors to allocate to, identifying within that sector what are the best companies that don't have funding needs for the next 2+ years, have strong balance sheets and stable cash flow. All those things are important to avoid tail risk and understanding where you're how you're compensated for the risk. And if we move to the next slide, maybe best represented. So this is ultimately what we do. We get our process. We do this on a monthly basis or as frequently as we need to do. So here on the top to bottom, you will have return expectations for everything that we invest in. And from left to right, it's the confidence we have in investment view. So you will oversee the portfolio. We do this, and this is what we run for the funds I manage. The other multi-sector funds that I ran is managed out of US and globally. This is how we form investment views and how you would expect allocation would follow this closely. So given this view, you would understand how we're allocated. So you can see agency mortgages. We have very high confidence in the actual returns we can expect. We have strong return expectation. And given it's all the way to the left, that is a reflection of our confidence in that view that they will deliver strong returns. It's a liquid sector, high quality. A lot of them have been trading at a discount. So you're not exposed to prepayment risk, because if you get prepayments, you're getting paid at par for something you buy at a discount. Rates are very high. Mortgage rates in US are very high, and we need to see rates much lower for any prepayments to actually happen. So we're quite comfortable, and they're offering spreads that are higher than you get for investing in investment grade credit. So we find that as a very attractive opportunity. And we've looked at all the different outcomes. And then as you move from left to right, you get sectors where we think there is more downside, you have less confidence. And interestingly, as you move from agency mortgages down to high yield, you're not getting much added return expectation, but you're getting much more uncertainty. And so therefore that would be reflected in the portfolio. We have reduced our credit allocation. We have a low high yield allocation. We have very high agency mortgage allocation, and that's where we think we have comfort. And so that's how we structure the portfolio, our process to identify that relative value, ranking everything. This is showing you a subset. Obviously, we're investing in broader set of sectors. So the opportunity set is much broader than what you see here. We're just showing a subset to visually help you understand how the process is structured. And so that is in line with how we're invested. So I'm not going to spend more time on the process. Yes.
Yeah, if I can jump in for a second, I just want to make sure we don't run. I want to make sure we don't run out of time, but I guess I just want to, because I think you do have a page in there that talks about performance since the system's been in. So if you could touch on that, because I think that would be helpful for the committee, and also just to sort of summarize for everybody, because I know there are a lot of moving pieces here, but essentially this is really a kind of a go anywhere, do anything in fixed income, and so you have a lot of flexibility. But maybe you can just give everybody an idea as you're talking about that performance. What is the objective? We know you're benchmarked against the global ag, or are you really keyed in on that benchmark? Are you thinking more, no, we have an absolute return target and this is what we expect to do over time? And have you done it since you worked with this group? So if you can kind of focus on that, I think that'd be helpful.
Absolutely. Okay, sorry. Yeah, I just know we were asked to sort of do process and as well.
Sure. No,
we'll skip into that. Ultimately, the objective of the fund, we will consider the index. It's a go anywhere fund, but we focus on outperforming the index. Through shorter period of time, we will deviate from the index quite a bit, as we are not on a day-to-day basis trying to replicate the index. We want to, through time, deliver better returns than the index and outperform the index strongly. And not, so when we're making allocation decisions, they're not based on the index, but ultimately we want to deliver volatility in line with investment grade fixed income and outperform the index on any longer period of time. And if we go to the performance, I would
page
say
25. We can pop over to that page there, Sue.
Yep.
There you go.
So over that, you can see over the longer period of time, 5-year number, we're 100 basis points ahead of the index. That's roughly what we want to deliver for this fund over any longer period of time. As I mentioned, and if we go back, so if you look at the 3-year numbers, we're lagging the index. This is as of August, but 5-year numbers is sort of what the composite has done. This is it. Your 5-year numbers is in line with the composite, roughly 100 basis points ahead. I would say, there is the beginning of the mandate. We had a rough 2018. That was a challenging year that really affects this inception numbers here. And if you go back to the attribution, you can see year by year data. Let me see if we can find that.
Page 20.
Page 20. Page 20 would be, gives you a little bit of just the annual behavior. So we started in 17, had a good run. We had 2018. That was really the tightening cycle when the Fed started tightening, we had a really negative, versus the index quarter in 2018, the end of or second half of 2018, that underperformed strongly. Since then, we have continued to deliver alpha in most of the years. As I said, the last couple of years, we've been much closer to the index. We've gone conservative, we've reduced credit, and we've gone through quite a significant change in the portfolio. Throughout the years, post-COVID, we had been short duration, long credit. We took advantage of the dislocation in COVID to add a lot of credit risk, which we took profit on into 22, where we benefited in 20 and 21. We've reduced that credit quite a bit. Spreads became extremely tight, and what sped up that process, we had the Fed starting to tighten. We had war in Ukraine starting. That to us created a lot of uncertainty, a lot of tail risk in the market, and we reduced credit. We started to buy back duration, and we increased duration we were continuing to be short the index all the way into 23 as we're going through a tightening cycle, and then ultimately moved to duration much close to the index, and we remain overweight, and we've been overweight for all of this year. And we're certainly benefiting over the last few weeks. We had a very strong August. We're having a very strong month to date as the portfolio is positioned for this easing cycle that we expected by being, having steepening bias and duration that is now over 1 year longer than the actual index. So we're closer to 8 years versus the index being below 7. So it's been a big transition selling out of credit. We've bought a lot of mortgages. We've built up a significant allocation to mortgages. What we like about it is they're high quality, they're very liquid, they're very defensive, they give you carry. And what we are ultimately designing the portfolio is been surprising with this tightening cycle is we've had hiccups like the banking crisis, the Silicon Valley Bank and other banks. But the Fed was quite quick to calm the market. But typically in every tightening cycle, you have a growth scare or you have something break. And despite the Fed having started to ease, we think it's prudent to be more conservative in your allocation, to not be overweight credit and now being long duration. We are going through a growth slowdown. And as even though the market has high confidence in the soft lending, having as you slow and as you get slower and you get closer to trend growth and even below trend, you always get growth scares. And we saw that in 2018, which was surprisingly quick. And just in 2018, the Fed had just started their tightening cycle. We had a growth scare, spreads blew out by 200 basis points and rates rallied by over 100 basis points. We haven't had that episode. Credit has continued to perform and hold up extremely well as the Fed has kept that soft lending scenario in place, and growth as published by GDP has held up. But we're starting to see quite a lot of cracks showing up in the labor market, and very broadly, small businesses. We're seeing very low confidence in small businesses. Earnings in small businesses have come off quite dramatically. Consumers are stressed. We're starting to see increased use of credit cards, increased delinquencies on credit cards, and same for autos. So stress is happening, and what's unusual with this tightening cycle is that there's been this big wealth transfer. Basically, consumers and small businesses are struggling. Big companies have benefited from being able to fund in public markets where you have tight spreads and strong equity markets. So they continue to benefit from cheap funding. And many of them have strong balance sheets, so they're actually gaining from having, strong cash balances that are actually getting more returns from cash balances. So you have that wealth transfer from small businesses, consumers into larger companies, and we're starting to see those cracks. And we would expect the economy to continue to slow. So we're expecting lower inflation, lower growth, and lower rates. And we're starting to see that come through. And the Fed is starting to react, but there will be lags on Fed policy as we go through the easing cycle as well. And so expect further slowdown. Sorry, yes.
Yeah, I was going to say our time is up. Are there any
Okay, sorry.
to close out on so we can move forward in our meeting? Any questions
Yes.
from the board, which is the committee or staff?
No, I don't have any.
Okay. Jeff, did you have anything you wanted to ask in addition?
No, that's very, very helpful. I guess the only other clarification I want, because this did come up sort of behind the scenes, is, and this is just for clarification for the committee, that this is a commingled fund, and I think the group knows that, but it was discussed that there's a separate share class that the system is in. So can you sort of explain that to everybody, what that separate share class is, and just how that feeds into the fund, and just talk a little bit about that structure?
Sure, I can go ahead and take that. So this is a collective investment trust. So essentially, it is its own investment. So the plan is invested alongside essentially other investors that could be invested in this. It's its own class. It is the only investor. It is the only investment in the share class. So the way that CITs work is each one can have different fee structures or different arrangements, essentially negotiated by your consultant or the plan itself. It is the only investor in the share class, and Jan and Carol invest it the same way they do the other pension plan and other assets that they had spoken about in the strategy. So they do look at it the same way they do the other investments strategy. So we look at it like a composite. So they invest alongside of it. There could be maybe a country or two that they may not be able to invest in, but I don't know what the dispersion is between the other portfolios, but they do invest it the same way.
But is it a different fee structure then? Is that why it's separate from the others? Or I mean, what would be the rationale?
It actually is. It is the only in the CIT itself, Jeff. That is the only share class.
Well, there's only one share class.
Yeah.
Okay, I'm sorry. That I was under the impression that the system had their own share class. So okay,
they do have their own share class, and it is the only share class. It is the only. Yeah, the CIT is the only investor in the CIT.
All right, now you lost me. So is the system the only investor in this strategy?
In the commingled fund, not in the strategy. There's I forgot what the AUM is in the strategy, but the strategy has quite a bit of AUM. It's
a number of accounts. Yeah, a number of accounts. And so what we have is we manage a usage fund that is managed in line with this fund that is obviously Iris.
362 billion in the strategy.
Okay, well, I don't want to get too bogged down into this, but probably something I think we're going to want to learn a little bit more, I think, just behind the scenes and talk about that, and then we can sort of report back to the committee on that structurally.
Sure, absolutely.
Okay, great, thank you.
And I'm happy to follow up with you and Gwilda on that.
All right. Thank you all.
Thank you so much.
Thank you.
And thank you, Jan, for joining us at late at night. So
yeah, no worries. Thank you.
Our
Hopefully
pleasure.
we managed to get at least most of what you needed. Thank you.
thank you all.
Have a good day.
So Sue, since this is later on the agenda, I think we need to put this in front of Robin Skeller so we can go ahead and discuss it now. And because Jeff is going to have to pop off probably before the discussion. So unless there's some kind of reason we'd like to go ahead and address this now.
Okay. Yeah, they're in the waiting room, but I emailed and said had something else that we would let them in as soon as we could. So
I'll start it up, and then Jeff, you can pop in. As you know, during the last meeting, this has been a segment that has been a bit challenged. The Neuberger Berman Opportunistic Fund, since inception, this is through August. I'm going to double check these numbers, but it's below the benchmark. And the Lazard EMD is below the benchmark. Now, over the past 1 year number for Neuberger, they're ahead, but the longer term numbers are a bit more challenged. And Lazard has basically underperformed the emerging market debt portion of this opportunistic bucket is below in all of the rolling time periods measured. So the Loomis, our Strategic Alpha Trust, has done pretty well. And of course, the TIPS is just an index fund. So we had mentioned during the last meeting that we possibly want to look at restructuring this and possibly bring in a search, including to include Neuberger in the search to see how they stack up versus other opportunistic, rather than slicing and dicing this all the different ways. Is basically either to have one of your current managers either split the Lazard EMD between Newburgh and Loomis, or replace one of those with an opportunistic manager. And basic opportunistic, they can go where they see the value in this segment, rather than us trying to have all these different managers. And you're probably getting a better fee schedule, I would imagine, with consolidating some of this. Jeff, did I miss anything, or do we need you want to expound on it a little bit more?
No, I think that was well said. Again, just to clarify on that, sorry, bad camera angle here. The Lazard EMD, that's a very focused strategy right now, and that's been, there can be some additional volatility in that. And we've got these managers like Newburgh, and again, we'll kind of see how they stack up against the rest of the universe. But between that manager and Loomis, they're already investing in emerging markets, and they'll sort of toggle that allocation along with everything else in their portfolio, high yield, credit, governments, everything else, based on the opportunities they see. So that rather than us trying to have the strategic decision of, hey, is emerging market debt good today, and should we have a strategic allocation and try and figure out what that should be, we'd rather have these types of managers make that decision, kind of like we do in the core space. So those managers, we don't have a separate treasury manager or a separate corporate manager. We're letting our core managers make that decision how they would want to be allocated. That's really the most efficient way to do that. So I think that's what we want to explore. And just as part of that, we'll bring a search to the next meeting. We already have it in the works with our research team, to take a look at a few other of these managers and to see how that works, and then potentially come up with a restructuring of the overall fixed income, the opportunistic fixed income portfolio.
Any questions or discussion on this? And if we'd like to know if you guys are in agreement with us re-looking at this.
Lazard is not minority owned, is it?
No.
No, I didn't think so. Oh, no, absolutely. I'm thinking of somebody else. If we can consolidate and I'm all for it. I'll take your recommendation as to where those assets should be placed. But you said you're thinking of the Loomis.
Well, yeah, the Loomis Strategic Alpha Trust has done fine. The Newburgh has been off and on. They were both in 2017. Alpha Trust has done better. It's right in line with their benchmark, whereas the Newburgh Berman is below for maybe a couple less months of performance. But the Lazard EMD just has not done well, and you've had them since 2016. They're almost 200 basis points below their benchmark. So that's why we're saying just get two good opportunistic managers and let them go where they see where the value is, rather than us trying to carve out a separate EMD. Yeah, that's what we're thinking.
No, I agree. It's always good to look at fresh eyes and look at the returns, and we can look at the global geopolitical climate. Everything is the same for all these managers. Right. So when you look at internal management and how they manage the assets, that's what it comes down to. And when we're not getting the alpha that we need for the fee that we're paying, we really need to look at it. And since they are on watch list, right?
Yep.
We're doing the correct thing in reallocating assets per your recommendation.
So,
and Gwilda, since if we want to do this really quick too, just to kind of prime everybody on this, if you want to talk a little bit about the watch list criteria.
Your watch list right now, we wanted to get some clarification, understanding. Your watch list criteria is 2 years. Is there a particular reason why it's not, what is the industry standard of 3 or 5 year rolling, rather than it's 2 years? Because what's happening is you're having, it's putting a lot of people on watch where that really isn't a long enough period to evaluate a manager. The different market cycles. Is there a rationale why we have a 2 year rather than a 3 year or a 5 year, which is pretty standard in the industry?
I think we started asking for this report when I came on 2004, 2005. I don't remember, Sue, I don't know if Andrew has any of the changes, and I'm so upset because I literally just cleaned out my closet that had 10 years of changes and markups that I had made over the years for recommendations to the board. And I don't recall when was the last time we switched it. And I don't remember if we were 3 and went down to 2 or if we've always been to 2. But if we need to make a recommendation to move it to 3 to give managers more of a full cycle kind of analysis, then I think that might be the best time. I think that would go through the Rules and Regulations Committee. Correct, Sue? To be able to recommend a change or would it be here? The investment guideline, the investment committee would make a recommendation for changes, but then it would still have to go to the rules and regs.
Well, I mean, we've done it a couple of different ways. I mean, if it's just related to investments, we might be able to, just do it with the investment committee because it does have to eventually get to the full board.
Mhm.
I had a question, and the question I have is, well, you also mentioned 5 as well. Do you think that 5 would be better going forward to keep than the 3? Or do you think that
done it both ways, and we look at 2 different measures. We're looking at the returns versus their benchmark as well as the peer group. 5 years, of course, is more time. I don't know. Jeff, what do you think?
Yeah, I think we would probably set it up sort of similar to the way the chart that you see in the book looks now, that if we have 2 categories, the first one has, I think, there's some quarterly results, and then the next one is the 2-year results. Again, we think those are kind of short, but I think we would probably have the same concept with a 3 and a 5 year. So we would say, okay, 3-year return relative to benchmark and rank, and then 5-year return to relative to benchmark and rank. And if it's missing both, if it's missing a number of those across the board, then that would probably trigger watch list. So whereas if it would let's just say it was below median on a 3-year rank, but above the benchmark on a 3-year, and then making both criteria on the 5-year, then that really wouldn't warrant watch list. So it would be something, it's got to be missing a bunch of criteria across the board on a 3 and 5-year basis to trigger watch. So I think it just gives a little bit more of a longer market cycle and in some leeway. So we're just not constantly having head fakes for managers on watch.
Right.
So do you think?
We put both of them in there. We put 3 and 5 year.
Yeah, I think 3 and 5.
I would think so.
Chris, you and Albert, and you all can take a look at that with Gwelda and Jeff. But I think 3 and 5 would be better, and then we have a little more flexibility.
Yes.
Chris?
Yeah, I agree. I believe that, we can change it and then be able to modify it if we have to. I mean, sometimes 5 years for me is a really long time to see, as Bobby's on here, to see red numbers on a manager. But if it's, a rolling 36 months, I kind of would like that better. So that we're capturing, we're capturing maybe an upcycle or down cycle on a year for a certain manager on a rolling basis instead of on a calendar basis. But I would prefer the 3-year.
Yeah, it's going to be rolling for both.
Mm-hmm.
Yeah.
So what will we need to do to make that recommendation? Sue, would it be a motion?
Yeah, I mean, if we want to maybe at the next meeting, look into it, talk about it a bit more and have Jeff and Gwelda kind of put together.
Yeah.
Be able to see
Gwelda, I'll send you an email and
Okay.
see what, to see what it would look like.
Okay.
And Chris, when you look at the whole thing, you and Albert, kind of look at what Jeff made mention of with the 3 and then the 5. We say, would it be co-mingling or whatever you want to call it, but possibility looking at 3 and 5, and then that way we would really be in line with everybody else. That's what I'm thinking.
Yep. I'll send Gwilda an email and CC Martel and Albert, and then we'll come up with, you know, some options, and we'll be able to present them at next month's investment committee meeting.
Perfect. Thank you.
And then the full board meeting would meet after, so it could go into effect if approved that October 21st.
Okay.
Sounds great. Good green plan.
Okay, those are our main issues, and then you've got Robbins Geller, and then we'll do the flash report.
Okay.
Yeah. So Robbins Geller, it was last month or the month prior, we had two firms in, Motley Rice and Labaton, that do securities litigation and portfolio monitoring. We already had Robbins Geller on board. They came on board in early 23, I believe. So yeah, there was some discussion, and the trustees were interested in hearing from them. So they are in the waiting room. I will let them in. Hello.
One second.
There we go.
That's better, I think. Hi.
There we go. Yeah. Good evening. Thank you. Apologize for the delay in letting you in, but we appreciate you being here this evening.
Of course. Thanks for sparing the time for us. My understanding is that we're going to give you a quick overview of what we do, what the practice involves, and what the monitoring may yield. And to help that, I have a few slides to put up on the screen, if that would be okay with you guys.
Sure.
And we'll go through that and use it as a reference point. Is that Mr. Cross I see behind you?
Yes.
Hello, Mr. Cross. Very nice to see you again.
Good to see you again. How's it going?
I'm very well, thank you. How about yourself?
Everything is going very well. Thanks for asking.
Good. Of course. And to all of the other people gathered online, hello, good to meet you all.
Hello.
So I'm going to go into the slide presentation now. It's should be coming up on your screen. And the first slide entitled Securities Fraud. Is that visible?
Yes.
Yes. Okay. So in live presentations, I'll occasionally ask for guesses as to what the cost is of securities fraud in the United States on an annual basis. But this setting isn't really situated or suited for that. So it's up here on the slide. It's estimated that securities fraud costs investors around $830 billion each year, which clearly is a huge number. It's a number that was produced by academics in Canada a couple of years ago. It's being updated, I understand, this year, and it hasn't received any real attack on its estimates or its conclusions. I happen to think that it may well be a little bit inflated because they use in the study some restated financial events where there hasn't been a fraud case that's accompanied it. So there could be some innocent restatements in that figure. But even if there were, you're still talking hundreds and hundreds of billions of dollars a year that's cost investors. So we think it's a very serious area that needs to be paid attention to. What can you do if you pay attention? Well, the investors themselves have powerful tools. Investors like your pension fund have powerful tools to remedy at least some of the abuse. As you can see from this next slide, over $100 billion has been recovered over the last 25 years. This slide was produced a while ago, actually, and when I say over $100 billion, I now say significantly over $100 billion. And my guess is it's heading up to 150, and it will surpass 200 billion before very long. In addition to, now, of course, that's still, I wouldn't say a drop in the ocean compared to the 830 billion a year, but it's a significant amount. And as I'll talk about in a little while, we think that not only is it meaningful in terms of recoveries and how many pensions can get paid out from some of the recoveries, it's also a very powerful deterrent factor, we think. But in any event, in addition to getting some money back, not in every case by any means, but in appropriate cases with the leverage that we have, by the time we have the evidence that we need to prove a fraud, we're able to insist, if our clients want to insist, upon governance reforms where they would be needed or helpful to reduce recidivism. And these governance reforms of the types that you can see on the screen are the sort of governance reforms that many investors or managers of investors dream of getting through engagement, but never can because they don't have sufficient leverage. And occasionally we do, and our clients do, and we're able to get significant reforms. And I'll get into some of the reforms that we've been able to force recently a little bit later. But as you can see, separation of the CEO and chairperson is a very important thing, we think. A lot of investors don't think that that position should be united. It doesn't help. Rotation of auditors getting too cozy with issuers has been a problem for a long, long time. Executive compensation packages that are steered towards the executives to the detriment of the shareholders. All of these things can be addressed in the right circumstance as a result of resolving our cases. We have a significant presence in the field. In the last few years, Cornerstone reported that between 2019 and 2023, essentially 43% of all the recoveries in this field were by my firm. There's a slightly different statistic produced by another outfit, not Cornerstone, another outfit that analyzes securities class actions called Securities Class Action Settlements. And when you look at their data, which doesn't cover 2019, you'll see there's a slight variation. But the bottom line is we've recovered between 37 and 43 to 44% of the monies recovered over the last few years. And I'm pretty sure that 2024 is going to reflect that again and maybe in an upward direction. As you can see, excuse me a second. Yeah. Why is it that we're able to achieve that sort of percentage of recoveries in such a significant field? And it's partly because of size, and it's not because size necessarily is better, but the cases that we're involved in aggregate are producing hundreds of millions of dollars, often billions of dollars in damages. And as a result, the companies and the executives that we bring cases against hire from the corporate coffers, of course, and their insurance policies, the very best Wall Street lawyers they can find, and then array them against us and competitors in our field. I was one of those Wall Street lawyers once in a past life, and I can tell you that one of the modus operandi is to try to outspend your adversary. And if they're plaintiffs' lawyers who fund their own litigations and work on contingency, that's possible to do that. So it's very important to make sure when you're engaging in this litigation, number one, that you obviously vet your lawyers as you would any law firm, but also be sure that they have the wherewithal to take the cases to the limit, because it will cost for any one case potentially tens of millions of dollars to bring the case to trial, and if necessary through appellate proceedings beyond that. And in that vein, we are the largest in our field by a significant factor. We have about 200 lawyers, and in addition, we keep in-house and employ financial experts, former bankers, forensic accountants, investigators, and we have a very large team that looks at the data that our clients provide, including you, to estimate any losses and damages so that we can advise you as to the best course going forward. And we've been most recently, and I think most relevantly, singled out as essentially the firm that will take cases to trial. And that is why, according even to our adversaries, we will be able to achieve significant premiums in the outcomes of the cases that we're able to lead. Trial experience truly does matter. I don't know that it's possible to maximize the outcome of a case if you can't present a serious and credible threat of taking a case through trial. And believe it or not, although there have been thousands now of cases filed pursuant to the securities laws over the last 25, 30, 40 years, in the last 20, 25 years, there have probably been less than 25 cases that have ever gone to trial. And of those, we've brought the most significant number, the highest number, and there's no question that that threat resonates. This year, on the eve of trial, we've secured $490 million for investors in Apple. We've scored $434 million for investors in Under Armour. But in that case, I mentioned corporate governance reforms earlier on. In that case, we also were able to get the CEO and the chair position separated, pursuant now to a binding agreement. And we also were able to force significant financial metric conditions to any stock awards to the CEO, the CFO, or the chief legal officer. So important governance reforms in association with that. That settlement has yet to be finally approved. The approval is scheduled for November 7th. The Apple settlement that I just mentioned was finally approved in Oakland, California 2 days ago. The judge was very complimentary. And as I mentioned in this slide, we also, on the brink of trial, settled significant cases recently against Dell, Twitter, and First Solar. And again, the reason it's worth emphasizing that is because trial is so rare, and the danger that you're always going to have if you get involved in this litigation with the wrong partner is that you're going to not be in a position to be the credible threat you thought you were going to be at the beginning, and you end up, if you're not careful, having to preside over a disappointing or suboptimal result. So the choice is very important. We have a number of record recoveries, and I'd be crazy not to show you them since we are responsible for them, but and we're very proud of them. But again, I think it just underscores that we take our cases very, very seriously. The defendants take us very, very seriously. And as a result, we've been able to obtain these record recoveries in a number of genres of securities fraud. Having said that, I should emphasize that first case, 17+ billion, that's not a securities fraud case. That's the Dieselgate scandal. And the recovery for the purchasers of or the people that were hurt by the Dieselgate scandal in the USA. That's the $17 billion recovery that you can see there. And then across two from there is the $5.5 billion. Again, that's not securities fraud. That's an antitrust recovery related to Visa and MasterCard's practices over a number of years. This year, I've mentioned some of these cases already. There's the Apple case, which was $490 million recovered. The Under Armour case, $434 million recovered. The Alphabet or Google case, $350 million recovered. And then, unusually, an individual investor, as opposed to an institutional investor, was the only candidate, a viable candidate for the lead plaintiff position in the case against Zoom, but presided over a settlement of $150 million earlier this year. I'll come back to this unique benefit slide in a moment, if I may, and just go quickly to some others. And one that I thought might be relevant is to see just that educators, funds for teachers and professors have been involved in very significant litigations and presided over very successful recoveries. In Enron, of course, that's the largest securities fraud recovery ever so far. And the plaintiffs there were the regents of the University of California. We were the lead counsel. And they were the same lead plaintiff in the case against Dynegy. And as you will know of TIA, correct, they were lead plaintiff in the two bottom cases against ARCP and Valiant, and again presided over very significant recoveries. No question that investors of all stripes are candidates if they have sufficient loss in these cases, and teachers are included. I should add that it was USS, the University Superannuation Scheme out of the UK, that presided over the $3 billion Petrobras settlement a few years ago. And in terms of publicity that's generated as a result of the outcomes of cases, it's typically well received. Beneficiaries, as well as the people that run the fund, tend to be in receipt of what we think at least is very good publicity. The Norfolk County Council Pension Fund is a UK pension fund, but came all the way out to Oakland and presided over the litigation against Apple. And when they had this headline in the London Times, it was something that both resonated for the people who ran the fund, but more importantly for their beneficiaries, who were able to read that and realize that their interests were being looked after aggressively. Again, Under Armour, similarly, that was a UK fund, Northeast Scotland Pension Fund. Again, it doesn't matter what nationality the investor is in this litigation. The question is, how big is the loss? And is that loss bigger than anybody else who's turned up who wants to lead the case? So all of these cases have been the result of investors like yourselves talking to their lawyers once a loss has been identified, being advised whether or not to seek the lead plaintiff position, and being told that if you want that lead plaintiff position, you apply, your lawyers tell the court what your losses are. You tell the court that you think, because you don't know of any other loss, that you may have the largest loss. That a date is then set by which anybody else must file their applications, and the court will pick as the lead plaintiff the entity that appears to have the largest financial loss in the litigation. And that entity, typically nowadays a pension fund, will then choose their lawyers. Typically, they choose the lawyers who they made the application with. And those two entities, the pension fund becomes the quote unquote lead plaintiff, and the lawyers become quote unquote the lead counsel. So Under Armour was led by, as I say, North East Scotland Pension Fund. The Apple case against by the Norfolk Pension Fund. We have a case ongoing now against First Energy, which is being led by the Los Angeles County Employees Retirement Association. We have cases that are being led by Taft-Hartley funds, by Indiana State funds. Again, as long as you're an investor that suffered a significant loss, you may have the opportunity to be proactive in achieving a recovery. So how do you know about your losses, and how do you know that you could be significant in this area? As Susan knows, it's a product of our monitoring program, which we instituted some 20 or 25 years ago. And through the monitoring program, custodians for our clients provide us with access to the transactional data of the funds. We're then able to analyze the data and then produce reports on a periodic basis that provides you with timely information about what your losses are and whether or not there's a deadline that you need to be aware of. That would be the first case that I've shown you. That's the the United States monitoring reports, which is about claims that arise as a result of investments in the US, in US issuers. And it tells you what your loss is if a case has emerged or if a case is under contemplation, and what the deadline is for making any application to lead the case. The other reports that we give include the International Monitoring Report, which does very much the same thing, but with respect to non-US cases. That's less comprehensive in a sense, that there isn't any international docketing of, of cases. The US cases, at least at the federal level, are quite visible as a result of the docketing that's necessary for each case. For non-US cases, as I say, there isn't any international and often no real national docketing that's reliable. So we scour all of the information sources we can to provide meaningful information about non-US opportunities. Another report is the settlement report, which allows you to identify, or allows us to identify for you, cases where there are settlements in which you may be a beneficiary because it's apparent that you have investments in those securities. So those are the principal support reports that we provide. And I said I'd go back to the slide earlier, and that's this slide, which was why monitor? Well, I think the monitoring is important regardless if you want to have information about what your losses are and what your options are. Another unique benefit on this screen is the fact that in each of these cases, no other firm, no other lawyer filed or got interested in any of these cases. So this was purely our firm identifying the cases and then being able to identify whether or not losses among our client base matched and were sufficient to allow us to do anything. And in these cases, we were able to do something to the aggregate tune of almost $3 billion. So we think that's very significant. I'm a litigator. I've litigated cases here for in the States now for well over 30 years. I've been at this firm and its predecessors for over 30 years, but I was defending these cases for 6 years before I switched sides. And I now work both, not surprisingly, you may note, with UK clients, with European clients, but also with domestic US clients, and I'm delighted to do so. Ruby Menon, my colleague who's on the screen, I've worked with Ruby now for more than 20 years. Ruby was a pension fund lawyer in Colorado for Colorado funds. She can describe those to you, and in Indiana before that. So she has both the great perspective of a pensions lawyer working for a pension fund and having worked with us and in our field for the last 20 years. And Ruby and I, as I say, we work very closely together, and we have done for a long time. I think with that, that's sort of covered what I hoped I'd be able to cover. And I hope there's some time for questions if anybody has any questions. And of course, if Ruby would like to add anything, I'd like to ask Ruby to do so.
Yeah, I wanted to add a couple of things, and I've mentioned this to Sue, when we first started discussing the portfolio monitoring, is that, as Mark said, our firm, because it's big, we have lots of resources, not just the lawyers, but with other services that we can access. And so funds like yours, when trustees have questions for the executive staff, then they can reach out to us about specific investments where, they see certain trends and they want some more explanation about it, or even some other cases that they may get involved in where they're not lead plaintiff, but they want us to look at it and give them a second opinion. So those are the things that I think having us on your short list as a service provider, as a law firm, is a huge benefit. Because as Mark said, when I was in the pension fund side, I would contact the lawyers and ask them, because they don't charge. And, it's being a public pension fund, as you all know, the budget is pretty tight to retain lawyers on an hourly basis. So that's one of the added benefits. And then I also wanted to say that you may never get into a case just because you may not have the largest loss. And since our firm monitors for over 1,000 pension funds, we would know whether you have a good case. So it's very rare that we would approach you, although a fund your size or even smaller funds have led litigation, because many huge state funds like CalPERS and or CalSTRS, while they may have the losses, they would not be interested for different reasons. So it is some of the smaller funds that can actually make a change when they do participate as a lead plaintiff.
I'll just add on that note, in 2 cases at the moment, there have been losses sustained by St. Louis that are, significant in absolute terms, but wouldn't be sufficient to succeed in the lead plaintiff application. In a case against Ford Motor Company, you've sustained a $148,000 loss. In a case against ZoomInfo, you've suffered a $164,000 loss. As I say, in either case, that would be insufficient. In Ford, just given the market cap, that would likely be very insignificant in that sense. In ZoomInfo, obviously a far smaller market cap, or at least I think a smaller market cap, and it would be slightly more significant. But all it takes is for those losses to go up to the $400,000 or $500,000 mark and above, and sometimes below, but certainly above that. Then you do become potentially powerful players, should you be inclined to want to try to do that.
Thank you both very much. Do any of the trustees have any questions?
Yes, very impressed.
Thank you very much. Yeah, appreciate that.
Yes.
We want to come and
we
meet
don't
you
wish. Sorry.
No, go ahead, Mark.
I was just going to say, we don't wish sufficiently significant losses upon you. But if they materialize, we hope we can be of help.
Thank you.
All right. Thank you both very much. Good seeing you both. And appreciate work for the system.
Thank you very much. Nice to see you. Nice to see you again, Mr. Gross.
Yes, I'll see you real soon.
Okay, thanks. Bye-bye.
Bye.
You ready for me?
Yeah.
Okay.
Showtime.
I'm not gonna take long. It's real tight. I'm gonna hit the high points. So if you'll turn to our report, page 1. Next page. As you go back 1.
Well, I'm sorry, I stepped away for a moment. I have to deal with the 2-year-old. I watched most of the presentation. What was the resolution?
There was no resolution. If they wanted to show us all the different losses in the different companies.
Okay.
The only thing is I wanted to ask Sue is she receiving reports on a regular basis, or how often you're getting reports from Robbins Geller?
Yeah, month. So they're our current, we're gonna have Motley Rice set up to do monitoring for us, but Robbins Geller has been doing it since the beginning of 2020.
Okay.
Okay.
Just so everybody knows that even if you don't file as lead plaintiff, you will still get if there is a settlement, you will get your pro rata share. The fund will get its pro rata share, whatever the settlement is. Okay. Oh, if there are no questions, we'll move forward. I only take max 10 minutes. So as you can see here on this page, actually the month of August was a good month in the markets. If you look in that first column under month, you can see the strongest performing part of the equity markets was the developed international EFA at 3.3%, followed by the Russell 1000 value at 2.7 and the S&P at 2.43. If you look down a little bit further, you can actually see fixed income actually was positive and strong in the month of August, with the global aggregate at 2.37 or 2.4%, followed by the corporate high yield at 1.63 and investment grade bonds at 1.6, and the U.S. aggregate, which is what your domestic fixed income managers are benched against, at 1.44. And looking over, as you can see here, year to date, both in fixed income and in equities, very strong numbers, double digits in equities, with the Russell 1000 growth. No surprise by any of us that it was over 21% year to date. And fixed income, the corporate high yield year to date, 6.3%. So if you turn to the next page, you'll see here the gray bars representing the ranges for each of your segments. And as you can see here, the inverted triangle is where your fund actually sits in each one of these different portions of the market. And as you can see, everything is well within its target range. Actually, so you know that the market value of the fund at the end of July was $857,908,008. And you saw an increase up to $862,012,864 at the end of August. If you turn to the next page, Sue, you will see the return, the roll-up return, the composite return for the fund was 1.3% versus 1.86. You had some weakness in domestic equity. Specifically in domestic equity, it was large cap value. If you see here, was under the Russell 1000 value at 1.97. The manager there is Edgar Lomax. They were in last month, as you know. The fiscal year to date returns, they're below. The 1-year return, they're below. The 3-year numbers are in line. The 10-year numbers are in line, and the since inception numbers are in line, but they have had weakness. As you all know, we had them in last month. TCW represents large cap growth, and TCW actually has done well in the month. You see at 2.98 versus 2.08 for the Russell 1000 growth. Their 1-year number is strong at 33.4. As you know, the 3-year and the 5-year numbers were challenged. Actually going back, it's somewhat challenged due to the concentration in that benchmark at time. But as you can see here, the 1-year number is very strong at 33.39%. In domestic equity, other area in domestic equity, the next page is your small cap, mid cap, which actually protected in what was a difficult time for that segment. You see a negative 1.02 at the top, but if you had been in the Russell 2000, it'd have been negative 1.49. So your managers protected in what was a difficult market. Westfield being the best as far as protection is concerned, actually delivering a positive return over the Russell 2000 growth. Systematic, albeit negative, outperforming on a relative basis versus the value portion. The only portion that was under this benchmark was the micro cap, which is DFA. But not to be too concerned about these short-term numbers. If you look over the since inception column for all three managers, they've all delivered significant outperformance versus their respective benchmarks since they were hired by the system. If you move down to developed international, Fidelity was under for the month. Causeway, which represents more of a value tilt in international developed, actually outperform at 3.29 versus 2.56. On a long-term basis, these two managers have delivered since inception returns in excess of their respective benchmarks. Emerging markets was the other area of weakness in equities for the month of August. As you can see here, both DFA and Invesco, both emerging markets managers, albeit positive numbers, did not deliver what the benchmarks did in the month of August. DFA has had a stronger run in the last year. As you can see here, all the numbers there are in excess in every time period measured for DFA. Invesco has had to be more of a tough time since they've been hired by you since 2014. If you move over to page 5, we've got global equity, which is represented by Exponence, slightly under for the month, 2.39 versus 2.64. Fiscal year to date, though, strong numbers, albeit not with the MSCI World, but delivering a return of 14.2%. Since inception, they came on in 2020, 10.6 versus 12.21. Moving on to the next page, you look at fixed income. Your fixed income in total below at 1.39 versus 2.36, and that came mostly from the opportunistic portion of the fixed income. As you can see, your domestic core fixed income managers, Manulife, 4 basis points ahead of the Bloomberg aggregate, the 1.5. Ernest had a weak month, 1.33 versus 1.44, but no concern with either one of these managers on a long-term basis. If you look across the page, they have both delivered in excess of the the Bloomberg aggregate in all time periods and since inception for both of them. We've already talked about the opportunistic portion of the fund. As you can see here, as I discussed earlier, Loomis Strategic Alpha Trust has done a good job in their particular portfolio versus a custom benchmark. TIPS is just an index replication, so it's done fine. The two that we're looking at, some changes with most importantly Lazard EMD, and we will put the Neuberger Berman Global Opportunistic. We're bringing a search back next month, and we'll put that up next to some other managers in that area, and then make some determinations on how we might restructure the opportunistic fixed income. Page 7 is the next portion, which is your global TAA, global GAA. And as you can see here, PIMCO All Asset, they started out strong, but now we've seen some underperformance from them for the last year, the fiscal year to date in the last year, which has brought down some of their the 3-year return. But you look at the 5-year return, the 10-year return and since inception, and they've delivered in excess of their custom benchmark. In hedge funds, actually positive return over the HFRI Fund of Funds Composite, 1% versus 0.08. And as you can see here, both Whitebox and Grosvenor have delivered in excess of their respective benchmarks. And if you look at those two managers since their inception, they've delivered outperformance versus the HRFI Multistrat Index. So that kind of rounds it out for the month of August. Of course, the flash report for September, you'll be able to see what your numbers look like on a 1-year basis. But one thing I would like to note is that if you go back soon to page number Number 3. You should go up one more. Go up. No. Go. I'm sorry. Go forward to the roll up of the funds. What I'd like, one more page. I'd like to know here, fiscal year to date is 8.46. We've got another quarter. Well, we got the end of this month and another quarter. But unless something goes crazy, you will exceed your actual assumption rate of 7% in 2024, unless something goes cattywankers in this last quarter. I would tell you, I know there was some discussion regarding something that came out regarding the fund. As you all know, 2022 was a difficult year for the markets in general. Albeit the fund was negative in 2022, which is the first year that we came on as a consultant. The fund delivered over 100 basis points protected from the policy index in that year. In 2022, the fund was down 10.98. The policy index was down negative 12.12. And if you look at the broad markets, S&P was down 18%. And the Bloomberg aggregate was down 13%. 2023, you delivered well in excess of your actual assumption rate. Return for the fund in 2023 was 11.43%. You were only able to recognize a portion of it because you have 5-year smoothing in your actuarial, how your actuary calculates. So those are my comments for the flash report for August. And I'm open to any questions you all might have. A request.
Ms. Brother, thank you. You did a great job. I like how you cleaned it up. You say we were down low return, but we did good. If you can look at the history, how you cleared up. We went down, but we did better. So I can see it's like a roller coaster in this market.
Yeah, and that's one reason you have the smoothing method with your actuarial, because some years you're going to be significantly above, and some years you're down. So in order to smooth out that return, instead of you going year by year up and down, they smooth it out and only recognize a portion of it, which also smooths out the contributions as well, required contributions.
Okay, but thank you.
You're welcome. Thank you.
Okay.
And that's all I have, unless there are questions.
I'm good.
I have no questions. Bobby wasn't too disappointed at this report, so.
Thank God.
No, she did a great job. I'm pleased. You know, I heard a little negative, but she said we got another quarter, and I like how she said in 2022, due to COVID, it was like 10.9% or something. And now in 2023 is 11 points, so it's a point up.
Yep. We were 11.3 in 2023. You were down 10%, but your benchmark was down 12% in 2022.
Okay.
So it's a tough
up now
across the board for both the equity markets and the fixed income markets in 2022. In a tough market, yes, you were down, which you expected to be down because you're invested in the markets. But 2023, you did well at 11.43%, and we're on the right trajectory for 2024.
Great job.
Thank you.
Are there any other questions?
I had just one, if I wanted to ask the trustees just for a few minutes. We have on Tuesday, we have our Personnel and Professional Contracts Committee meeting for our pension administration system, and we would want to do that in closed session. And I was hoping perhaps we could take that vote tonight with our committee for that committee to be closed, and things could go a little quicker for that meeting on Tuesday, if I could ask for just a few extra minutes.
With that, I'm going to exit.
Thank you, Gwilda.
Everybody have a great day. Bye-bye.
Okay.
Thank you, Gwilda.
Thanks.
Bye-bye.
Sue has presented the motion up on the screen. Can I get someone to read the motion for us, please?
If you all, can you hear me okay?
I can hear you, Shanice.
I can.
All right, I'm gonna attempt to read it because the square is in my way. To close, I move to close the September 24th, 2024 meeting of the Personnel and Professional Contracts Committee, and that all records and votes, to the extent permitted by law during the closed portion of the meeting, will be closed pursuant to section 610.021 subsection 12 of the Missouri Revised Statutes, for the purpose of having a confidential and privileged discussion on contract matters.
Now Richardson second.
It's been properly moved in second. Are there any questions? Hearing none, can I get a roll call vote?
Christina Bennett,
Yes.
Louis Cross,
Yes.
Shanice Johnson,
Yes.
Martell Mann,
Yes.
Bobby Richardson,
Yes.
and is Doris still?
Doris is,
Doris?
she's voting, how can I do this? She wanted to vote, but she's in court, so how do I do it?
Okay, well,
She said yes.
Yes, okay. We'll take her verbal,
Okay.
so. Okay, Albert's not here, so.
Absent, yeah.
All right, so we do have 6, so the motion carries.
Carries, okay.
So thank you all very much. That will allow things to go a little smoother, quicker on Tuesday.
Okay.
All right. Is there anything else on the agenda, Sue?
There is not.
Hearing none, can I get a motion to adjourn?
I would like to make a motion for adjournment today.
There a second? I
Can I
second.
second too?
No, Christina will second.
I
All
second
those
it.
in favor, please say aye.
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 All right, everyone, enjoy your weekend. Enjoy the balloon glow, the Hispanic festivals, all the activities happening this weekend, and we'll see everyone on Tuesday.
Okay.
Okay, and you know, we having a porch festival in our neighborhood. They have different bands that play on people's porches.
Awesome. Well, enjoy the weekend. Enjoy.
I like